Market Structure Mondays with Tim Quast, the founder of Market Structure Edge. Tim, good morning. How was your weekend?
It was good. I'm in Amarillo live from a hotel room in Amarillo.
I knew that was a hotel room. And, I was going to make a guess. That wasn't the Tim decor, because
definitely not the Tim decor.
The pillow
it's
matches.
It's the curtain. If he lost the curtain, he might have had us fooled. But that curtain is hotel-y.
And the lamp. Look at that lamp.
It looks like it was arranged by someone who would spell spoo, S-P-O-O.
Do you know why it's like why everybody says S-P-O-O? Because I believe the origination was from the September contract of S-P-U. So where's S-P-O-O come from?
We have the resident expert on that here in the proverbial room, don't we? It's Joel.
I know, but he says it's S-P-U. I agree with him, S-P-U, because I think it came from the September contract. But the whole market spells it S-P-O-O, and I'm just like, where did it go wrong? It's like hodl and hold. Is that where it came from? And S-P-O-O came from S-P-U, but S-P-O-O was cooler.
Whatever the case, Spoo would be a good name for a thrash metal rock band. Spoo. That would. It's not
a good name. That would be Joel's rock band.
Tim, I would love your thoughts on Friday afternoon. Right, 2:30 comes around, and for the final half hour of the day, the market rallied. Do you have any insight you can share with us as to what was behind that rally?
Yes, I do, and I would refer to the market as a Gavrilo market. That's what we have right now. We have a Gavrilo stock market, and for those of you who are history buffs,
wait, are you referring to Gavrilo Princip?
And there we go. Well done, sir.
Oh my gosh!
Right. Wait! I got a reference.
Jesus,
you did. Well,
I didn't know I needed a thesaurus and a history book during these interviews. I got the thesaurus out. But
that is, you need a baboom ching there that you can do, Spencer, because that is pretty good. That's some obscure knowledge that you possess. So for those of you who aren't as good at trivia as Spencer Israel is, Gavrilo Princip was the fellow who kicked off World War I. And no one knew that a nationalist, a Balkan nationalist, a Serbian, shooting the Archduke of Austria, Franz Ferdinand, which is the name of a rock band, by the way, would kick off this unbelievable years-long tumult. And I'm not saying that one little thing will necessarily be that cause, but it has been. It has been the worst month for the Nasdaq since October 2008, and worst for the market since March 2020. And one little thing did that. And so to bring it around to let's bring Spoos and the rally on Friday and Gavrilo Princip all together. And here's what I think, the grand unified theory is that explains what happened Friday afternoon. So today there's a massive futures contract that is tied to the S&P 500 that expires. It's a monthly contract that the SIBO created in 2014. And they did this in response to the explosion of passive investment. And passive investors aren't investing to try to outperform the market. They want to be the market. They want to track it. And as those things got bigger and bigger, it became more complicated to try to buy and sell hundreds or even thousands of little fragments of stocks. So instead, there's this futures contract. Okay, so this leads into why Friday was a huge rally. So generally, there are large banks who supply those, and the banks will offset their liability. They're not front running a customer order. It's different than say, hey, go buy 500,000 shares of Apple for me. So a broker, it's against the law for the broker to put his order in ahead of that. But if Goldman Sachs supplies a futures contract to BlackRock to true up whatever index funds and exchange traded funds on the last day of the month, now that bank can do whatever it wishes to mitigate its losses, such as buying a bunch of stuff and shorting it simultaneously on a Friday right before the contract expires. That can happen. And why would that occur? Well, you have to change your thinking about the market, traders. What is the motivation of a massive amount of money today? Well, if you're a bank, it's to not lose money. You want to either make money supplying services, helping investors transfer risk. That's how Lloyd Blankfein explained Goldman Sachs' business. He said, we are in the risk transfer business. We help people transfer their risk in this thing to that thing, and we collect a fee for doing that. Well, look at what happened over the trailing month. The NASDAQ dropped what? At the extreme level, it was almost 20%. It's down about 13% now, I believe. So we had massive destruction since that contract last reset on roughly, what was it? What was the last trading day of the year, Spencer? Was it the 31st? I can't remember.
Precisely. It was the 31st.
Okay.
Yep.
Okay, so from the 31st of December to the 31st of January, crazy tumult involving futures contracts. The assassination of Franz Ferdinand occurred. And so that's why we had the massive surge on Friday as banks drove up assets and shorted them in the hopes that today everything comes out level. That's what's happening. And we can actually see this in the data. I can tell you that active investment has plunged. This is not the product of active investment. It was a week ago. Active money was selling. Now it is all what we call purple. It's all risk management. There's a 20-day increase in risk management across the whole market. I don't remember seeing that before. It's as big as I've ever seen. So if that all sorts out, and there is no Lehman Brothers behind the scenes, some bank that really took a shellacking during this month, then we're going to be okay. If not, we won't. But that's why. It wasn't rational behavior. It was risk mitigation.
So in theory, this could all just be routine market plumbing and when the month resets and the futures contracts reset, that's that. I mean,
yes, but the trouble is that the normal volatility in the S&P 500, what I'll say, ordinary course is about 1.8%. So intraday volatility is the amount of movement between intraday high and low prices on average in a component of the S&P 500. Well, over the last week, it is 4.1%. So we are colossally greater than the averages. And nobody hedges for that. No one prepares for a 4% intraday move. So yes, it is normal plumbing in the sense that every month this occurs, and the woe for indexes is volatility. You don't want tracking errors. And at 2%, you're in trouble. You need to keep it below 2%. Well, we're more than double that. And so that is abnormal. It is normal plumbing under abnormal, very unusual circumstances. Now, if you're confused about all of this, it's just one of the things that you have to think about, folks, that a major part of the market, this involves trillions of dollars, isn't deploying capital to invest. It is, how do I make sure that the stuff I own at this moment roughly reflects how the S&P 500 is performing? What if I had what if I was overweight Netflix? Because I was tracking the S&P 500, but I was growth biased, meaning I'm going to stack my money into growth instruments, and then it loses 40% of its value. My tracking errors are off the charts, and I'm going to have to get those square or I'm in trouble. Well, I gave that responsibility to Citi, to Citigroup to handle. So what's Citi going to do? They're going to trade like freak shows to try to mitigate that. And that is what leads to some of these crazy moves that people think, well, what in the world is going on? That's what it is. And it's so large, it is so massive that it outstrips the underlying assets. The trading in derivatives on a notional basis is larger than the trading in stocks.
Is that always the case?
No, that is a phenomenon of just post-pandemic trading. Prior to 2020.
When you say derivatives, really what you mean is options, or I can't imagine the future. Yeah, but I can't imagine the futures market is that has grown that much.
Well, part of the reason that it has exploded, we've absolutely set futures records in 2021, is because the trade size keeps getting smaller. Last week, the trade size in the S&P 500 was 99 shares. That's less than the minimum bid and offer under current rules. And so what happens is it's very difficult for any index to true up a position. It's very easy to transfer that risk to a futures contract so a bank can just do it. And so that has grown and grown and grown since the pandemic. The trade size has collapsed. It was, prior to March 2020, the trade size was close to 140 shares. So you'd say, well, 140 to 99 isn't that big a change. Well, it's 38% or so.
Yeah, it's big.
It's a massive change.
Is that retail driven? Is that just because there's so many newer customers that are trading 1 share and 2 shares? I mean, I see this all the time.
So.
It's annoying for me as a prop trader. It's like I get filled on 3 shares of something. I get filled on 5 shares of something. And I'm like, holy. And it's obviously, there's some smaller traders out there. It used to always be, I always thought it was like maybe some other traders that are just trying to figure out where the liquidity is too by throwing 1 share all around. But there's so many small shares. Got to be a lot of that average size got to be retail driven.
Absolutely it is. There's no question. And then the intermediaries are going to use that reality to make more money. I pay a little commission at Interactive Brokers so I can see that. And I'll trade 20 shares of Netflix or Tesla, and my trade will be split into 4 or 5 pieces. And so one piece, I pay a tiny little, I pay a commission. Let's say it's $1. But then the other 3 trades, there's a penny commission. You say, well, that's no big deal. Well, it is if you're collecting an additional 3 pennies and you do that thousands of times a day. That's material. Right. And if you're a high frequency trader, you get the risk for a high frequency trader is that you're on the wrong side of the trade. So the smaller the trade size, the lower the risk for them. I'd rather take intermediate 5 shares than 500 shares because I don't have any risk. I can turn right around and sell the 5 shares to somebody else, particularly through a retail liquidity program, and get paid a fraction of 3 shares, 3 cents a hundred on that. So all of that stuff, this stuff, Dennis. We're kind of in the weeds there, but this is why, to me, you have to know market structure, traders. You can't just wander around out there without knowing what's going on.
So as we wrap up here, Tim, and there's a good question here from Pablo in the chat. He's wondering how the supply in the queue, supply and demand is looking for this week right now.
Great question. Let's look at it. That's Pablo. You're thinking exactly right. You want to know what the supply demand in everything is. What's it in the S&P 500? What's it in the stocks that you're trading? What's it in the tech sector, cannabis stocks? You can always look at that. So let's have a look at it. And as bad as things have been, it's there. I think one more step. Sorry, guys. We are. Haven't done this in a week. Okay, so moving away from my aging visage to this is market structure edge. So traders, this is your sole tool to understand the supply and demand in the market. That's what those 2 graphs are. And so you got demand on the top, supply on the bottom. And in the ideal trading world, demand is rising and supply is falling, right? That's how you get higher prices. And you can look across here and go, well, they look like the opposite of that. Well, right, exactly. And Pablo, to your point, right at the top, broad market sentiment on a 10-point scale is 3.1. Let's click through that and have a look at it. So this is the SPY. SPY is, and we're not tracking intraday, that's just closing price. We do track it, but because we don't want to trade price. You will get beat trading price. Yes, you can get lucky, but remember, somebody is always faster than you. The high frequency traders are the Otto Boldens of the world. They're faster than everybody else, and they will always fool you. So don't get caught up in that. Understand supply and demand. Well, so here's the price, and this smoother line is demand, and it tends to be between the red line 6. You get above 6, and the probability of additional gains diminishes greatly from a mathematical standpoint. You get below 4, and the probability of gains begins to rise significantly. We are way below 4. This is the second worst. The last time it was this bad was March 2020, which, by the way, was the worst we've ever recorded. We developed this measure in 2011. So we began tracking these data the same way, January 2012. And while this is very bad, this read right here is very bad, it's not even in the top 30 bottoms, though. So we'd have to get all the way below 2. However, and well, let me finish that thought. It's still falling. It's falling all over the market. Supply is still rising. That is why the market will struggle. When those two conditions stop, even if just demand goes down or supply goes down, a short volume in the S&P 500 right now, 48%, meaning it's almost parity between long shares and short shares. And looking at the data during options expirations, much more money shifted short than normal. So there's a whole lot of people who are short the market. They could be wrong. That can reverse very, very quickly. But Pablo, the answer is, if you looked at that, you'd say, would I buy that? No, right? No, I'm not buying. I'm not going to try to grab a falling knife. It could change in a day. I don't, we get through today. We're into a new month, new chance for hedge funds to make money over 23 days, the average trading days in a month. A whole new chance to take risk, new money coming in from 401ks, unless everybody stopped. So you get past today and you're in this condition, there's a strong probability in the next week of a rally. But today, very, very challenging.
All right, Tim Quach, founder and CEO of Market Structure Edge. Link on the screen and in the description. Tim, always a pleasure. Have a great rest of your week.
Back at you. I'll catch you in Colorado next time. We're on the road out of Amarillo.